What's up, trader? There are two ways you can approach a market: by trading or let the trade come to you. And in fact, this is the basic difference between an amateur trader and an experienced trader. An amateur trader trades all the time, but an experienced trader waits patiently to let the trade come to them so that you can take the advantage. If I give you a clear example of understanding, let's assume that you were waiting for some water and there is a bucket is being filled. An amateur trader will try to collect the water from the bucket as fast as they can, because they assume that if I don't take the water fastest way, then someone might take that water away. But an experienced trader calmly wait without anything. Why? Because once the bucket is filled, the water will automatically spill out of the bucket in their own bucket. And that is the approach that every professional profitable trader takes in the market. Understanding this, trust me, will improve your trading in a huge spectrum. So in this video, I'm gonna discuss a very important topic: overextended market condition. This is where you will see the bucket is filled and the water will automatically spill into your bucket. Once you understand it, it becomes much easier for you to read the market, when to trade for a bigger profit target. And in this video, I will step by step show you what are the criteria of understanding an overextended market. That you saw that I always talk about overextended market in my video. And the second stage, I will show you how you can trade, in what situation you can trade an overextended market for a bigger profit target. Sound interesting? Then smash the like button, hit that subscribe button if you haven't done yet. This is Forex Wizard from Forex Trading Wizard Academy. With that being said, let's get started. Okay guys and girls, so before we jump on the real chart to show you quite a few examples, first let me explain the clear idea of an overextended market, and then we will look at the chart. Now first of all, from the name, overextended means that there is something excessively over. So what is a criteria of being an overextended market? In what situation you can consider a market is overextended? Now the best way to understand an overextended market is to identify the market structure first. So to be considered an overextended market, there has to be a break of local structure, such as breakout from a trend line, from a channel, or from a support and resistance. Very clear. Let me give you an example and then we'll look at the chart. So let's say a market is moving in an uptrend, creating series of higher high and higher low. Normally a market will never move in one direction. At some point you should see some kind of rejection. Now once the market moving like that, as a rule of thumb, the market should test the previous resistance, turning support here, and again should do the same thing. This is a textbook example of an uptrending or trending market. Now at some point you see that this trend will break, okay, either to the upside or downside. Now to be an overextended market, when you see that next time when the price is coming down, we assume that it should test the previous resistance, turning support, and should go back up again. But in a sense, what happened is that you could see the market has broken the previous swing low. That is where we consider an overextended market. Now why this is important? Because most retail trader makes a big mistake in this area. Retail trader think that okay, there is a breakout from the trend line. Okay, this is the trend line, and breakout from the trend line, it has broken the support, so the market reverse, let's sell. This is a good time, but as a matter of fact is that trend is not created in one day. It's not gonna be ending in one day as well. So in that case, what you could see that after creating an overextended market, you will see the market will again reversing back in most cases, because without proper consolidation, without proper reversal pattern, a trend will never end at all. So this is one criteria that you can understand an overextended market. This is in a trending situation. It could be in a sideways market. Let's say a market moving in a sideways, has a drop and then has gone up, has come back down, like that. At some point you see, most cases you see that the price normally break this resistance. It's look like that the market has in fact has broken out, but as a matter of fact in most cases you see the market has gone up, created an overextended from this resistance level, and then has come back down again in the range in most cases. So especially if the, let's say if the long-term trending direction is down, the price is consolidating and then has gone up, you see in most cases the price will reverse back to the range. So this is another example of overextended market. So there are many other ways you can identify. Let's say a channel, okay, a market moving in a channel, creating series of lower high and lower low, okay, and suddenly you could see the market has broken out of the channel, even in the direction of the trend, created a strong impulse, created an overextended market, and then has immediately gone up. So these are the criteria that you will be considering to understand an overextended market. Break up local market structure. Now let me give you a couple of examples, then we will come back to this chart again to understand the criteria of trading in an overextended market. Okay guys and girls, so let's look at this example. Keep in mind that this concept you can apply in any time frame as long as you identify proper market structure. Now as you can see on AUDUSD, we saw that there is a change of trend in this zone, and then the price created this uptrending market structure, impulse correction. So you see that every time the price was creating series of higher high and higher low. Now at some point what you have seen that normally the price should have respected this swing. As you can see, the price was creating series of higher high, okay, and then higher low. Now quite a few times you can see that the market structure has been violated. First of all, in that zone you can see this is the previous swing low, the previous resistance here, okay, turning support here, and you see one narrower candle, a pin bar, has penetrated this previous support zone here, completely violated the market structure, grab liquidity. This is an overextended market situation, okay, and then we have seen this impulse to the upside. Now the price has done exactly in the same way. You see this is an overextend, has broken down the local structure to the other side. Now this is the previous swing low, again this is the support, and also we see the same situation. The price has broken down completely and then immediately has gone, and there has been a big move to the upside. Now the same thing here as well. If you draw this resistance level, if you draw this trend line, what you see that when the market created an overextended market condition to the downside, and then once the price has created this impulse, the price did the same thing. The price has broken to the upside, again created an overextended market to the upside. It doesn't have to be on the downside, it can be in any direction. So once you saw the price has created an overextended market and then immediately has gone down again. So these are the examples. Now you can see quite a few situation here as well. You can see the price was moving along this structure, creating series of higher high and higher low, and suddenly you saw there's a big impulse happen to the downside, completely has broken out of this support zone. And with that breakout, what you can see that AUDUSD completely has broken down of this support and then created this overextended market to the downside, breaking all this level of support, and then again immediately has gone up. Now these are the zone where most trader trap. Now think that okay, the market reverse, let's sell short, but unfortunately a trend will not be ended in one day, and you'll see that again the price has started to go up in the direction of the major trend. Very simple to understand. We saw quite a few examples in a situation where trending. Let's see a couple of examples when the market in a range to understand an overextended market. Now this is a recent chart on gold. Now this is a recent chart on gold, guys. As you know that in 15 minutes, and a gold does this all the time, especially when gold in a range or in a consolidation market. Now as you can see, this is 15 minutes chart on gold, and we see that the market was ranging for quite a while and then created this pattern. Now you can see that if you identify this resistance here, you see that first of all the price tested this very important level of support here with this long wick candle as a resistance, and we have seen a rejection from this resistance. Now with that rejection, what you see, the next the price has gone up, penetrated completely to the upside, and then closed with a long doji and strongly rejected again. And if you closely look at, you see this move, it's a big move, and that is where the trading comes in. So what we see that this resistance has completely been violated, overextended to the upside, and then has rejected. Now the same thing here again, once the price created this dip, created this move to the downside. Now in the same thing, we see that the price has formed an overextended market to the downside and again created this impulse. Now with that impulse to the upside, we see the same situation happen. If you draw this resistance level, what you see that the price basically have done the same thing, tested this resistance and then created an overextended market to the upside. And with that overextension, what you see that the price in fact has rejected. That's an amazing trading opportunity. Now you have found how to identify an overextended market in a trending or in a ranging market. Now let's find out in what situation, in what cases you can trade an overextended market. Now to trade an overextended market, we can consider some of the criteria that I normally personally consider. The first criteria to trade an overextended market is a strong rejection. Okay, when the market is overextended, as a trader we normally watch the market like a hunter. When a hunter, you know, watching its prey to hunt, it requires a great deal of patience so that the prey in the right place, tired enough to catch the prey. In the similar way, as a trader we need to be patient to see a clear rejection from an overextended market, because an overextended market may turn into a real movement anytime. Everything is possible in trading. So what we need is for the price to get rejected, so that we know that this is an overextended market, the price rejected, now we can jump on a trade. This is the first thing I will show you in the chart as well with examples. Now the second criteria that I personally use is dropping down to 3 popular time frame for a reversal. So what do we mean by this? Let's say I'm trading on 5 minutes, right? Now with the trading on 5 minutes, now if I see a market is overextended on the 4-hour time frame, okay, what I do is I drop down to 3 popular time frame for a reversal in that overextended zone to take a trade. For example, the popular time frame, if it is a 4-hour overextended, the popular time frame is 1 hour, and the next one is 15 minutes, and the next one is 5 minutes. Okay, so I will be waiting for the price to create an overextended market, a reversal pattern on the 5 minutes time frame for an overextended on the 4-hour. Now it can be applied to monthly as well. Let's say you found a market overextended on the monthly time frame. Okay, now if it is a monthly overextended, then let's jump down to 3 popular time frame: weekly, daily, and then 4-hour, right? So if I see a market overextended on the monthly time frame, then I'll jump onto the lower time frame, such as on the 4-hour, for a reversal pattern for finding a trading opportunity. Now let's jump onto quite a few examples to understand this criteria so that you can use it straight away in your trading. First, let's look at this example on gold that just we have seen on the 15 minutes time frame, guys. As you can see, the market basically initially, let me replay the chart so that you understand how it works. Now when the price has come here, you see that this is the previous resistance zone, this is previous support zone, turned resistance here, and exactly the price tested this level, an important level, which is also a big part of this big move here. So that support, turned resistance here, and from that level we have seen the price has in fact been rejected strongly to the downside. Now with that rejection, next what happened? Let's replay the chart, and we see that the price penetrated the same level. This is where the real trade comes in, guys. As you can see, from that resistance, the price penetrated to the upside, created this overextended market that we are talking about, and then immediately has rejected with this long doji or a pin bar. This is the trading candle. It's a big rejection from this resistance level, and then with that rejection, what do you see? That the price has a strong movement. If you trade this market with this at least 3-to-1 reward to risk, which is in fact a very good trade, because the price penetrated this resistance level, overextended to the upside, and then rejected. This is the rejection candle that you need, a strong rejection that will tell you that, okay, this is the trade that I can take. Now you know that the market rejected with a very strong pin bar. As you can see, this pin bar, you can identify it. It has to be a textbook price action, a pin bar, or a strong doji, or a bullish or bearish engulfer that will tell you that, okay, this market is clearly rejected. The sellers are fully in control in this long-term downtrend. Let's go short. And then you can see that afterwards, in fact, this has moved considerably to the downside. Now let's see another examples of dropping down to the lower time frame. Now look at this example, guys, in 5 minutes on AUDUSD. Now you can see that this is a clearly defined downtrending market. Okay, on AUDUSD, the price has an impulse, okay, with this movement, and then created this consolidation or retracement, and then there has been, so the price every time creating series of lower high and lower low. So this is a long-term downtrending market structure. Now from that zone, what you see that this is an impulse to the upside on AUDUSD. Now this is an overextended condition, breaking the trend to the upside. Against the trend, the local market structure is completely violated, completely broken to the upside, and then from that overextended market we have seen a strong rejection. Now this is where the trading comes. Once you saw this market has broken to the upside without any notice, and then immediately with this long bearish engulfer. Now this is where we are talking about that strong rejection. Okay, if you see a narrower candle here, that I wouldn't be trading, because that means the sellers are not strong enough. Once you saw this strong rejection, a bearish engulfer, as you can see, it has passed this green candle, completely to the downside with a full body red, this is where the real trades comes. And even if you enter the trade once the candle close with a stop loss above this high, in fact it is an incredible trade. Easily 3-to-1 reward to risk is easily achievable. Amazing trade, as you can see. So we have seen a market which is trending and in a sideways. Now let's look at how you can identify a 3-time frame down reversal pattern. Okay, so let's look at this example on US30. I was just replaying the chart so that you can see it clearly. Now this is the monthly chart. You can see that this is the monthly candle. Now when this monthly candle formed, look at the top of this candle. It has crossed this doji high. This is the resistance level on the monthly, and this is a very important level of resistance level from the monthly perspective. You can see that the price created this overextended market to the upside with this long bearish engulfer, and you can see that after breaking this high, the price has a strong rejection. Now let's draw a circle here. Now let's say you saw this market on the monthly, the price has overextended to the upside, right? What is the next step is dropping down to 3-time frame, because you saw that the market is overextended on the monthly. There is an opportunity on the lower time frame. So dropping down to 3 popular time frame is so monthly, and then jump onto weekly, daily. Now on the 4-hour we should see a reversal pattern. Let's look at the 4-hour time frame to see how we can see this market here. Now you can clearly see that on the 4-hour time frame, the price in fact has created a nice looking double top formation with a strong impulse, double top, strong rejection to the downside, guys. Amazing trading opportunity. Now once you see this, no one can stop you from being a profitable trader. You know that, you understand it. The market is overextended on the higher time frame. There is an opportunity on the lower time frame. Now easily you can trade it after creating the double bottom on the neckline. Even if you place a pending order as a swing trader, if you want to do that on the higher time frame, you easily can achieve 3 times target without any hesitation. This is an incredible trading opportunity, guys, when you understand this concept of overextended market. I sincerely believe that, guys, this video was helpful to you. Thank you for watching, and also don't forget to subscribe. Also watch these 2 videos, will be really helpful to you in your trading. Thank you. I'll see you soon in my next lesson.